Welcome back. My name is Chris and I have been studying and trading Forex for a while. During that time, I have experimented with lots of trading indicators and without much success, I stripped them all off my charts and reverted back to basics. Nowadays, my focus is just on price and reading the price action on naked candlestick charts. I hope that this one will help you to become better at reading price action too. In this one, I will explain how to read a candlestick chart. I will also talk about common candlestick formations and what they mean, and show you how to use candlestick charts in trading. Candlestick charts plot price over time. The vertical axis on the chart represents the price, or what the exchange rate is between two currencies. The horizontal axis represents what the price did over time. Currency price movements are segmented into intervals, and each interval has 4 data points. These data points are the opening price, the closing price, the highest price, and the lowest price for each interval. Time intervals typically range from 1-minute periods to monthly periods, meaning that you can view the price chart where price data is segmented into 1-minute intervals, 5-minute intervals, hourly intervals, and so on up to monthly intervals. Each interval has its own opening price, closing price, highest price, and lowest price. So, for example, if you are viewing the H1 charts, each interval represents 1 hour's worth of price action. The opening price is plotted at the beginning of each hour and then for every hour for as long as the market is open. The closing price is constantly moving throughout the hour until the end of the hour when it becomes fixed. As the price action unfolds for the interval, the candlestick is being drawn in real time. If you are viewing the M15 chart, each interval would represent 15 minutes worth of price action. The opening price would be plotted at the beginning of the hour, 15 minutes past the hour, 30 minutes past the hour, and 45 minutes past the hour. There would be 4 15-minute intervals or candlesticks for each hourly candlestick. Similarly, 4 hourly intervals or candlesticks would make up 1 4-hour interval or candlesticks, and there are 6 4-hourly intervals or candlesticks to make up 1 daily candlestick. Basically, candlesticks blend together, and this allows you to view the market with different perspectives or with more or less detail. When you change the chart from the higher time frames to the lower ones, you get to view what happened inside the candlestick. I will talk more about that in just a moment. When the closing price is higher than the opening price, the candles are usually one color. In this case, they are painted blue and they are known as bullish candlesticks. Bullish candlesticks represent rising prices. When the closing price is lower than the opening price, the candlesticks are usually painted in another color. In this case, they are painted black and they are known as bearish candlesticks. Bearish candlesticks represent falling prices. That is how price charts are plotted, and I think you get the idea now. So let's move on. Each candlestick has a body and usually a wick above and below it. The body of the candlestick chart is made up from the open and close prices. This is the price area that is rectangular and filled. Bullish and bearish candlesticks indicate uptrends or downtrends in price for the interval or over a series of intervals. If the candlestick does not have an upper or lower wick, it means that the opening or closing price was also the highest or lowest price for that interval. If the candlestick doesn't have a body, then they can be considered indecisive candlesticks. How the wicks appear and where they appear on the chart can give you a clue. They can suggest a pause in the trend or a potential reversal of the trend. Candlestick formations can occur in many variations, and where or how they appear on the chart can have different meanings. We will get to this in just a moment. The point is that learning how to read a candlestick chart is like learning a different language. Looking at one candlestick alone is like reading one word. Reading a series of candlesticks together is like reading a sentence. When you can string enough sentences together to make paragraphs and chapters, you might be able to understand the story. And part of being able to do that involves knowing how to blend candlesticks together. Blending candlesticks involves using the open, high, low and closing prices of several candlesticks to create one. This is what allows you to view the price data with greater or lesser detail over various time frames. But it also allows you to see the hidden signals in the market that may occur over a sequence of candlesticks, not on any particular time frame. Let's start with a basic example with how the different time frames are created on the charts. This candlestick represents 1 day's worth of price action. We can see that it is a bullish candle and it has a body with wicks on the top and bottom of it. However, this candlestick omits the details about how the candle was formed over the course of the day. So on the 4-hour candlestick chart, we might see something like this. There are 6 4-hour candlesticks in a trading day. If we take the opening price of the first 4-hour interval, the lowest price reached from any of the 6 4-hourly candlesticks, the highest price reached from any of the 6 4-hourly candlesticks, and the close price from them as well, from the last one, they can be combined to equal this one daily candlestick. The daily candlestick alone tells us that the buyers were in control for the day, but the 6 4-hourly candlesticks, which provide more detail, tells us that the sellers tried to pull the price back halfway through the day, but then they got overwhelmed towards the close, and the buyers finished strong. There also doesn't seem to be any candlesticks here that might suggest that the buyers are starting to get weak. However, further analysis can be done on a lower time frame to determine whether the buyers are likely to remain in control in the short term. These two higher time frames suggest that conditions are likely to remain bullish. I hope this makes sense. I want to move on and outline some common candlestick patterns and explain what they mean. To become proficient in reading candlestick charts, you have to understand what the different formations mean. Traders use candlestick patterns and formations to signal trading opportunities or as clues to what the price might do next. This can be from a single candlestick or a combination of candlesticks, but like any other trading indicator, these are not absolutes and should not be used in isolation. It is best to use a combination of indicators when making your trading decisions. Candlestick patterns can either be categorized as continuation or reversal patterns, and as the labels suggest, continuation patterns usually signal continuations of the current price trend, and reversal patterns usually signal reversals of the current price trend. However, this is relative to the overall price trend and the time frame they appear on. The higher time frames take greater precedence over the lower ones. I will start with some bullish formations and then move on to the bearish ones, but they are just the inverse of each other. This is a sign of strength. These candlesticks have a relatively wide price range, a relatively wide body, with the price closing close to the highs. This also indicates that volatility or momentum picked up. This formation can also be seen as a sign of strength. It is a bullish candlestick with a wide price range and a relatively narrow body close to its highs. It shows us that sellers tried to drive the price down, but buyers recovered. When a candlestick like this appears after a move down, there might be signs of exhaustion or a temporary bottom might be forming. But after a move up, it can also be seen as a sign of weakness. This is a neutral formation. It is a bullish candlestick with a narrow price range. The candlestick's body is relatively wide compared to the range, but narrow relative to other candlesticks that might precede it. This formation can indicate that volatility or price momentum has slowed down, unlike the other formations with wide price ranges that show that volatility picked up. This formation can also be seen as a sign of weakness. It is a bullish candlestick with a wide price range and a relatively narrow body close to its lows. It shows us that buyers tried to push the price up, but sellers recovered. When a candlestick like this appears after a move up, there might be signs of exhaustion or a temporary top might be forming. But after a move down, it can also be seen as a sign of strength. This is a sign of indecision. It is a candlestick with a relatively wide or narrow price range with an opening and closing price close to the middle of that range. This formation suggests that buyers and sellers are equally matched, or the market is currently undecided about where to take the price next. Now for the bearish candlesticks. This is a sign of weakness. This candlestick has a relatively wide price range, a relatively wide body with a price closing close to the lows. It also shows us that volatility or price momentum picked up. This formation can also be seen as a sign of strength. It is a bearish candlestick with a wide price range and a relatively narrow body close to its highs. It shows us that sellers tried to drive the price down, but buyers recovered. When a candlestick like this appears after a move down, there might be signs of exhaustion or a temporary bottom might be forming. But after a move up, it can also be seen as a sign of weakness. This is a neutral formation. It is a bearish candlestick with a narrow price range. The candlestick's body is relatively wide compared to the range, but narrow relative to other candlesticks that might precede it. This formation can indicate that volatility or price momentum is slowing down, unlike the other ones with wide price ranges that show that volatility was picking up. This formation can be seen as a sign of weakness. It is a bearish candlestick with a wide price range and a relatively narrow body close to its lows. It shows that buyers tried to push the price up, but sellers recovered. When a candlestick like this appears after a move up, there might be signs of exhaustion or a temporary top might be forming. But after a move down, it can also be seen as a sign of strength. And this is a sign of indecision too. It is a candlestick with a relatively wide or narrow price range with an opening and closing price close to the middle of the range. This formation suggests that buyers and sellers are equally matched, or the market is currently undecided about where to take the price next. Each candlestick is trying to tell you something. What they are trying to say will vary depending on what candlesticks or price action preceded them. So let's take a look at some common candlestick patterns that might indicate continuations in the price trend or reversals of it. When you open your charts, it is best to take a top-down approach, meaning that these formations will be more significant on the higher time frames. I'm going to start and give you some continuation patterns and then move on to some reversal patterns. Here is the first one. The first one is what is referred to as an inside bar. The candle that preceded the inside bar is a strong bullish or bearish candle with a wide price range and relative body. This indicates that price momentum picked up. Then this is followed by a bar or bars with a narrow price range and relative body, and they are close to the previous bar's high, but the high and low does not exceed the previous bar's high or low, and this can form in various ways, like this. They all indicate the potential for the current price trend to continue higher or lower, and you can just invert this pattern for the bearish version, like this. For the reversal patterns, there is what is referred to as shooting or morning stars. Signs of weakness or strength can be seen after an up or down move in the price. So for example, after a run up in the price, a candlestick formation that shows signs of weakness might appear, like the last candle in this pattern here. This indicates that buyers are getting exhausted or sellers are starting to enter the market with strength. The inverted version is what is referred to as morning stars. Signs of strength can be seen after a move down. Then a candlestick formation appears that suggests signs of strength. This can indicate that sellers are getting exhausted or buyers are starting to enter the market with strength. There are many more patterns, and as a bonus, I'm going to give you a quick cheat sheet. You can pause the video to take a better look and further investigate these for yourself. Learning how to read candlestick charts requires study and practice. Sometimes they work and sometimes they don't, but that's trading. But being able to get a better read on the markets will help you identify trading signals and anticipate future price movements. So that just about wraps this one up. Good luck, and I will see you in the next one.